we've heard some fantastic presentations in the last couple of hours. So I hope there was something for everybody in there. And now let's move on to our closing keynote. And we are hosting it as a fireside chat, so it's a bit different than what we're planning with. No presentation style. We're trying to make this as interactive and informative as possible as well. And I'm joined by David Lund. He's the anchor of Kitco News. I'm quite excited to have him on. It is my understanding that this is his first presentation at a conference. So I'm quite excited to have him on and to have him join us. David, are you with us?
I am with you. Hi, Kai.
Hey, David, thanks for joining us from the Kitco News studio. Fantastic. Yeah. Let me cut over to my proper view here. Yeah. Let's get rid of the agenda. I really appreciate you joining us. I know it's PDAC week. I know it's insanely busy. So I really appreciate that you are making the time for us. And I can't wait to pepper you with questions and
It's a pleasure. It's a pleasure. I enjoy role playing, and this is a role reversal here. I'm usually the one to ask you questions. It's a pleasure. It's always a pleasure having you on in studio, even if it's the other way around, Kai.
Exactly. Yeah, it's hopefully we can see each other in person, because I don't think we've met in person yet, right? So it's only done virtual. But before we dive into the fireside chat discussion, let's start with David Lund. Actually, who are you? Right. I actually looked at your bio, and I saw you wrote for the Bull and Bear Report for a while. And I remember correctly, it used to be at PDAC where I used to see the newspaper style. Right. Is that the Bull and Bear Report?
No, I think you're thinking about something different. That was
okay.
That was the Bull and Bear was a business school newspaper that I worked for. I was editor for at McGill University. So I went to McGill for finance, and then it was a student newspaper. I put that on my bio because I was proud of it. It was my first foray into journalism. I actually didn't plan to be a journalist myself. I graduated from McGill in finance, and I started working in finance right away. I did macroeconomics research for 4.5 years at BCA Research, which is a macroeconomics research firm. They do independent macro research, and then I switched over to the journalism side 3 years ago, joining Kitco.
Is that your first foray into mining as well, joining Kitco then?
Yeah. Well, I mean, I worked a little bit on, I studied a little bit about mining from the finance side in school, but nothing professionally, no.
Oh, interesting, because Canada, you can't really avoid mining, right? It's almost omnipresent. I'm always amazed. Coming from Germany, I used to fly over here, and BNN, there was mining advertisements. Mining was a big topic, right? And there was nobody in Germany. That's just non-existent. It's completely different.
I remember in college, I did an investment banking competition. It was called the National Investment Banking Competition, hosted by UBC, the University of British Columbia. And so our team at McGill got into the finals. So we flew over to Vancouver, and none of us knew. There were two friends of mine, 3 people on this team. None of us knew anything about mining. The case was a mining deal. It was basically, you're an investment bank, pitch us a mining deal, why this company should merge with another company, and for how much. And we didn't know anything about mining. So actually, my friend and I actually walked down the streets in downtown Vancouver, hoping to go to some mining companies and ask them some questions and learn a little more about the industry. So basically, we were rejected by pretty much everybody. Who are these kids? The only company that let us in the door was Goldcorp at the time. And before they merged with Newmont, it was Goldcorp's office on I think it was Hastings Street. I can't remember, downtown Vancouver. And we walked in, and my friend was in a suit. I wore this turtleneck and this jeans. It's very casual. And then my friend was like, "We would like to speak with the head of IR." It's like, "Who are you guys? Do you have an appointment?" "No, we're just students. We like to learn about the industry." So we were doing this all morning, but she actually came down. She gave us half an hour. We asked her a bunch of questions about Goldcorp, about mining, about how M&A works. Very helpful. So
awesome.
For the McGill endowment funds, I went.
I always love Goldcorp because they were always quite innovative, right? They had the Goldcorp challenge, and that actually shows that a really interesting point. They are open for new ideas and new things, and keep a very open mind. It's sort of missing a bit from the industry, right? I have to admit, since let's talk about mining and what we're seeing here is do you see anybody else that sort of jumped into that? I don't see another Goldcorp challenge where they sort of nurture and foster new ideas, right? That sort of disappeared.
Either. I wish Rob McCune would do that again with McCune Mining. I haven't spoken to him about that. I don't know if you've heard anything.
Yeah, we should pester him with that, because I think it's missing. It's an innovation challenge, right? Because mining has a bit of a cliche that we're always behind the 8 ball and always the last ones to innovate to a degree, but I don't think that's true, right? So it just needs to be showcased more.
Yeah. I spoke to Sean Boyd of Agnico Eagle yesterday. Actually, I asked him this question about innovation, more from the technology side, and I asked him why hasn't mining had its fracking moment yet, and he gave me a very good answer. And he said, well, look, that mining has its own sort of development cycle. And I asked him, look, if I were a tech company and I were to present you with any technology that you wish that could improve your operations and your bottom line and raise shareholder value, what would it be? And he said, well, that's a pretty loaded question. It would be a lot of things, but primarily what they're using now is they're using more AI to sift through geological data, track where ores are going, and also just make the extraction process a little more cost efficient. And so I don't think miners are particularly looking for a fracking moment per se, but they're looking for ways to expedite the extraction process and reduce all-in sustaining costs.
AI is super interesting. A friend of mine is in data as well. He's a professor at a university in Germany as well. And we've often have discussions about it as well. It often comes down to input quality, right? Like AI, you can only build, develop tools when you know that the data is right. And in junior mining or in mining in general, like you ask 3 geologists, you get 5 different opinions. Right. So interpretation of data is always different. So that's a very interesting one, because AI, I think, has to adapt a lot to make it even more feasible. And I think we're seeing a couple of companies. I think Goldspot Discoveries is one that's sort of trailblazing. So I'm quite excited to follow them actually to see what's going on. So let's switch gears a little bit. Let's talk about the market. Right. Sure. And that was one of the reasons, of course, we invited you. Like, you get your fingers on the pulse like nobody else. But we want to hear what David Lin actually thinks, right? You speak to all the different decision makers, influencers, analysts, mining CEOs, right? But what's your take on the current market? Let's stay focused on gold and silver for now, and we can talk copper and all the base metals later on. But let's stay on that.
Okay. Well, okay. Let's talk about gold. So, I was thinking about what to say, and I have to first address a few. I don't want to call them misconceptions. I would say not commonly understood themes about gold. And first of all, these are all my own views. They're not Kitco's in any ways. They're just based on my own research and from my own findings, based on the experts I've spoken to. I've had you on the show as well, Kai. I've had to go back and watch a couple of your interviews to learn. I always enjoy speaking with you because I always learn something. So it was very interesting to do my research. What is gold is the question I ask myself. What is the purpose gold serves in one's investment portfolio? The common theme is that gold is an inflation hedge. And I think you and I have spoken about this theme. And what I found was that, historically speaking, if you look at gold versus the CPI, for example, the correlation is inconsistent at best. Gold isn't so much an inflation hedge as it is a hedge against real interest rates. And I know that people think it's an inflation hedge because the real interest rate contains an inflation component. Keep in mind, the real interest rate is the nominal rate minus the inflation rate. And so what it is really is it protects, and I spoke to Lynn Alden about this. She's the founder of Lynn Alden Investment Strategy, brilliant mind. I've had her on the show a couple of times, and she said that gold is a hedge against basically treasuries that are not performing well against inflation. So it's a protection against treasuries when it is beaten by inflation. And I think what she means by that is that gold is an asset that is replaceable, or is meant to replace other low volatility assets like treasuries. And so when treasuries are underperforming inflation, basically when the inflation rate is greater than the nominal yield, that's when we're going to have a rising real interest rate. When the nominal yield minus the inflation rate is lower, we have a lower real interest rate. And there's a negative correlation between the real interest rate and gold. And what we've seen over the last 6 months since August is the real interest rate steadily maintaining its position and perhaps even rising at some points, which has brought gold down to its current levels around below $1,700 an ounce. So I prepared a few charts here. If we can switch over to the charts, and we can talk about first of all this relationship and why I think it's significant here. So the first chart, if we can just click on that.
I think that's really interesting, because we're curious, like we got to touch on that while we're waiting for the charts to load, like how inflation is actually calculated. That's something that puzzles me, because it seems to change every time and whatever the political agenda is, right? So maybe we can talk about that afterwards as well. But let's focus on the interest rates for now.
Right. So this is a chart that I've made. It goes back a couple of decades, and the correlation is consistent. It isn't great, but it's pretty consistent. It has a correlation coefficient of 44%. And so what you see here is the yellow line, the orange line is gold on the left-hand side. It shows an annual percentage change. And on the right-hand side, you'll see the real interest rate inverted, the blue line. And I inverted it to show the two lines moving in tandem. Of course, if you actually show them without the inverse, then it would be moving in different directions. But this just shows how strong the correlation is over time. And so what we saw over the last decade, when gold peaked in 2011 and then fell towards 2012, 2013, then flatlined and then rose eventually in 2018, was that real interest rates also hovered around the same place and didn't really spike up all that much, which contributed to gold staying in the same place as well. And so really when you ask the question of where gold is going to go, you have to ask where are nominal rates going to go and where is inflation going to go. And I think this is another misconception I'd like to address, is that people are saying that the nominal rate is rising because inflation expectations are rising. Inflation expectations have not been rising. And people say that on media, they say it on Kitco, they say it on CNBC. My friend was telling me about it yesterday. Yes, individual economists have expectations that the inflation rate will go up. But if you actually look at the market, if you actually look at where the inflation expectations are trading in the market, the TIP ETF is a good example. The TIP ETF is produced by iShares, BlackRock iShares. It's an ETF that simply tracks the Treasury inflation protection security. And it's an asset that is pretty simple in concept. The principal value goes up when inflation goes up, and it decreases when there's deflation. And so when the TIP ETF goes up, inflation expectations, not actual inflation, but expectations for inflation go up. And what we've seen, the blue line is the TIP ETF. And what we've seen over the last month and a half is that the inflation expectations have peaked, but have sort of fallen down. And gold has more or less tracked that performance downward as well. The correlation coefficient between these two variables is 96% over the last.
Can I jump in
years.
for a second and ask a follow-up question there?
Yeah,
because
sure.
just especially that drop, right? Is that sell-on news now that the stimulus package is sort of like pretty much approved? It's supposed to be approved any minute now, I understand. But is that what we're seeing there, or is that taking it away already? The market sort of expects the stimulus to be approved without having an effect on inflation?
Yeah, I don't know how much stimulus has a direct impact on gold itself. Like you brought up the key point, which is inflation. Does stimulus have a direct impact on inflation? And in my opinion, it's probably already baked in. Stimulus has been happening since last March, and the additional package is not sizable compared to what we've already seen last March. So I don't see any, unless they really raise it. The last stimulus package is $1.9 trillion. Unless they really raise it by a lot more, I don't see inflation expectations picking up a lot purely based on fiscal stimulus. Of course, you have to also make the assumption that with fiscal stimulus, people are actually going to be spending the money and not saving the money. That's a critical assumption you have to make. The savings rate has gone down in the US, so it spiked during the pandemic. It has come back down to pre-COVID levels. So yes, people are spending their stimulus checks. They're also putting that into Robinhood and investment accounts and so forth. You can also make the argument that the TIP ETF tracks CPI, which is a lagging indicator. CPI is always a month behind. And so if you're expecting inflation to pick up, then the TIP ETF isn't going to show that right now. It's going to show that next month. And we are seeing it sort of bottom out, the TIP ETF. So it'll be interesting to see where it picks up from here over the next couple of months. My view is that we will see some inflation, but we won't be getting hyperinflationary scenarios.
Yeah, it's like at what stage do you see hyperinflation? Where does it start, right? Because the goal was always 2% inflation, and now with gold, with oil going up and some of the agriculture commodities going up as well. Like what's hyperinflation for you? At what point do we see that as well? Like, because it's really interesting. Like I'm really starting to I have a hard time wrapping my head around. And your statement as well, which is really interesting. That's why I love having you on. Actually, is if inflation is not happening, right? So, is it just really confined to certain asset classes that we see inflation?
Well,
and more or less, like how is it actually calculated?
Inflation is happening. Inflation is happening. This blue line is inflation expectations. Is what the market thinks inflation is going to go. So, if I have a perceived notion that inflation will be mute or perhaps even go down into a deflationary environment, the TIP ETF will go down because I'll be buying less of the TIPS. If I think the opposite, if I think that if I have a high expectation for inflation, and I think inflation is going to rise, I would buy more TIPS, and then that would drive up the TIP ETF, where any index that tracks the TIPS. That's not what we've been seeing. However, CPI has been rising steadily month over month. We have seen that headline CPI, core CPI as well. I don't have an exact answer as to what is in the CPI. It's a basket of goods, and the calculations, like you said, changes over time. The calculation changes over time. I know Canada just revised its CPI calculations.
Okay, I need to look into that. Yeah, okay.
Canada just revised the CPI. I spoke to Steve Henke, who's a professor of economics, applied economics at Johns Hopkins. He's one of our regular guests on Kitco, and he was talking about the revision of Canadian CPI. And apparently Canada actually admitted they were making a mistake for many years. Their calculations were erroneous. And so it wasn't just a minor revision that the government makes every once in a while. It was like a major revision of their methodology. And I asked him, can we see something similar in the US? And well, Steve doesn't really know. It's interesting to see. Maybe if they do even make a mistake, it's a matter of whether or not they'll admit it. CPI.
Politicians and economists admitting to mistakes is a rare sight, right? So it often gets swept under the rug, or so. It just gets, or is maybe a small footnote, right?
Yeah.
So,
but I do hear from the gold community that look, maybe the CPI is not a perfect measure of inflation, and maybe the gold market is not reflecting what inflation really should be. Well, that's a good argument. That's a fair argument. Well, to that, I would have two rebuttals. What is a better measure of inflation right now a reliable measure of inflation that we can look at? And second, if the gold community already believes that the CPI data that the TIP ETF is based on is not a reliable indicator of inflation, and that inflation should go much higher, why is the gold market not reflecting that belief? Why has it been trading down and not up?
Yeah.
So those
what is your belief? Like you've got all the different guests on. Some are calling for $10,000 gold. Others are calling for $1,000 back to $1,000. Like what does David Link think? What do you think about where gold is headed based on this? But what does your gut tell you?
My gut tells me we're most likely heading back up, but we probably won't reach all-time highs this year again. And the reason I say that is, again, going back to the real interest rate. Let's look at the two components separately. Nominal yields, we're seeing 1.53, 1.6. This is obviously a huge increase from just a few months ago, but it isn't historically very high. How much more room do we have to go? Well, the answer is quite a bit more room. And eventually, I think the Federal Reserve will step in on yield curve control, and stop it from going any higher, because that would be economically disastrous if interest rates rise to historically high as 5 to 6%. So I think above 1.7%, I've spoken to Peter Hugg about this. I think above 1.7%, the Fed might start to get worried. So let's assume then the cap is 1.7 to 2%. Then what we have to look at inflation. How much higher can inflation run this year? Well, okay. So a few guests have had different viewpoints. So Jim Rickards has been calling for 15,000 gold. He doesn't see inflation happening. He says if you look historically at what CPI has done over periods of monetary stimulus, it's actually not gone up a lot, right? We didn't see hyperinflationary scenarios after the last financial crisis when the Fed had QE 1, 2, 3, and 4. We had 4 rounds of QE over the last decade. Inflation did not rise in the double digits in the US. It just really didn't. And so his argument is that this round, we're not going to see that again. And then we had counter arguments like Steve Henke saying that, look, by definition, if you increase the money supply, you're going to have to increase inflation. If you actually look at the price of goods that have gone up, yeah, food is going up, energy is ticking up $60 a barrel for oil, agriculture is going up. We're seeing inflation trickling up. I'm not going to deny that inflation is going to happen this year. I don't see it going to much higher than above the Fed's 2% inflation target.
It's really interesting. Yeah, it's like you said, you just mentioned the things that affect people the most, right? Oil, which is gas, like whatever you put in the tank of your pickup truck, right? Food prices, real estate as well. Like because of the low interest rate environment, the housing market is swept empty, right? Here in Vancouver, and houses are being bought sight unseen, right? So I'm sure it's the same in the US as well. So there's inflation. I know it's the same in Europe and in Germany. My friends are looking for houses right now. They can't find anything. There's nothing available even.
Where they live?
Right. Just outside of Frankfurt. So it's an industrial area, right? But it's affluent area as well. Got a lot of business and all, but it's impossible to find anything as well. Same here in Vancouver, actually. Like I've been looking for fun actually at the rental market as well. There's nothing available. It's insane. So talking about real inflation, it's interesting. Like perceived inflation, real inflation, expected inflation is a really interesting discussion.
It's very confusing. Right? It's very confusing. Going back to your earlier question about whether or not we're going to get hyperinflation in the U.S. Well, by definition, we've never had hyperinflation in the U.S. again, people have different definitions. Steve Henke came on the show. He said that the definition of hyperinflation is 50% month-over-month inflation. We've never had that in the US. The last time we've had double-digit inflation was late 70s, 80s, following the OPEC oil crisis. And that's a great case study, by the way, for gold, because we saw really, really high inflationary environments in the early 80s to mid 80s, yet gold continued to fall throughout the 80s. Why is that? Well, because Volcker raised the interest rate above 15%, 13%, and then it eventually fell. So it's important to look at the context of inflation, look at inflation in the context of where nominal yields are as well. If inflation is high, but nominal yields are even higher, gold isn't going to go up. Let's take a look at this chart that I made.
Well, while you're pulling up the chart, I just want to remind everybody, like, we're going to get to some questions as well at the end of our conversation.
Please,
right? So make sure to use the chat or put it in the Q&A function. And we already have a couple, so we'll get to those. But yeah, just a quick reminder on that. Let's continue with the chart.
So I was, a lot of our guests have been calling for 10K gold. The guests on Kitco, you mentioned $10,000 gold. Look, they've made very compelling arguments as to why $10,000 gold will happen in a few years. They're not saying it'll happen immediately. I think it'll be pretty bad for the economy if it happens immediately, but they're saying, a couple of years down the line. And their arguments range from a devaluation of the dollar to hyperinflationary scenarios. We do know that, let's talk briefly about the dollar. We do know that there's an inverse relationship between gold and the US dollar. And that's for a lot of different reasons. So if we assume that this inverse relationship holds, then we have to ask ourselves what drives the US dollar. And at its most basic level, it's interest rate differential. So the rate of nominal rates in the US versus nominal rates abroad. If nominal rates in the US are higher relative to nominal rates abroad, then there's going to be capital flows into the US driving up the US dollar. Right now, we're seeing, even though we're seeing rates at still near historic lows, it's rising faster than the rates of other countries. The nominal 10-year yield in the US is 1.5, 1.6. In Germany, it's negative. In the UK, I'm looking at, let me just pull up some Bloomberg data here. It's near zero. Yeah. Germany, negative 0.3, UK 0.7. These rates have not moved up as dramatically as US rates over the last month and a half. And so that's why the USD has been strengthening. I see the strength continuing over the next couple of months into 2022. The US dollar might eventually devalue, but I don't see that happening right away if the interest rate differentials still remain high. Because keep in mind, look, I'm not a bond expert, but I do know that interest rates follow either inflation expectations and or the economy, the strength of the economy. And like I showed you, the inflation expectations have not been trending up. In fact, it's gone down. So that leaves economic growth. I think partly the reason why nominal rates have risen in the US is due to expectations of a reopening of the economy. And so a strengthening the economy means people are going to be buying less of the safe haven assets. They're going to push down treasury prices, pushing up yields. We can't say the same thing about Europe. I don't know how it is in Germany. I don't know how your friends feel, but I know most of Europe is still locked down. What's the sentiment like on the economy in Germany?
Well, that's a good question, actually. Like it is okay because people are working, but yes, as you said, there are still locked down. So I don't expect, like, exports are down as well because we can't manufacture like at limited capacity, right? So I know the cars, like the big car companies have a lot of car on hold and not as great. Like I'm curious to see, and we got to change a government this September that's holding stuff up as well. So I'm curious to see how that is developing, to be honest. Let me just double check the time. I want to talk about your Big Macs per ounce of gold index. I think that's a really interesting one. Just in the interest of time, we got about 5-10 minutes to chat and get to some questions as well, because I want to keep that interactive, because we got a couple of good ones in there. So that I want to get to, and I want to poke the bear a little bit on, see, like, if you could spill the beans on your guest a little bit. So
sure. So anyway, just to conclude the last thought, the point I was trying to make is that if the economy in Europe remains weak or weaker than the strength of the US, then you're going to see continued strength of the US dollar, which is going to continue to weigh down on gold, which is why I don't think gold is going to spike up considerably this year. Anyway, let's look at the Big Mac chart. So I've been thinking about $10,000 gold. What does it mean if gold reaches $10,000, but the US dollar has already devalued by a lot by the time it gets there? And so I thought about gold in relation to tangible goods. So The Economist has put out the Big Mac index to track purchasing power parity between different nations. I used the same index. I downloaded their data for Big Mac prices on their website, and I just made a Big Mac to gold ratio. So how many Big Macs can you buy with an ounce of gold? And what you've seen is that the purchasing power of gold has peaked in 2011. And even though in nominal terms, gold has breached all-time highs last year, in purchasing power parity terms, it has not. So you can interpret this chart in a lot of ways. You can say that gold has not been as effective in beating inflation as it could have been in the last decade, or you could say that there's still room for gold to climb if you assume that gold will eventually breach historic purchasing power parity levels. So there's an argument to be made there. I don't think we're going to have a deflationary scenario. We're not going to have negative inflation. So if you assume that we're going to have positive inflation, and if you also assume that that chart's going to go back to 2011 levels, then the only logical explanation is that in nominal terms, gold will continue to rise. Again, I don't think that's going to happen right away. Eventually, it will.
Good, very good point. Because devaluation of the dollar, I had a conversation with Don Tourette yesterday as well. I don't think it's in political interest or economic interest that the dollar is being devalued right now. It needs to show strength so that people understand, okay, the $1.9 trillion package is sustainable. That's my opinion on that. Right?
Yeah, very good point.
So,
yeah. Just very quickly on the dollar, people have been saying the dollar is about to collapse. It's going to go down to, sure. There's valid arguments about that. If you just take a look at the dollar index over the last 30 years, it hasn't devalued significantly. It's gone down a little bit, but not significantly. And we've had several rounds of quantitative easing and monetary stimulus. So it remains to be seen whether or not excessive amounts of monetary stimulus will actually bring down the dollar to very, very low levels.
It's interesting because it made me think about what Donald Trump said in his campaigns, that he wants a weaker US dollar to really boost economic productivity and make it more competitive. And it seems like we're still fighting that, right? So I'm curious to see like what the plan is and how much devaluation the government and the Fed will permit for the US sort of to become and stay more competitive. Because I think a way out of this mess has to be boosting economic productivity, and a lower US dollar will help with exports. That's just my very bare bones economic analysis, right?
I think you're absolutely right, Kai. And look, you have to understand the dollar and inflation are two sides of the same coin. All else being equal, if you have inflation, the dollar will devalue because you can buy less goods with the same amount of nominal terms. So, one of the most interesting arguments I've heard for inflation is that the government actually wants inflation. We're at $30 trillion of public debt right now in the US. And if interest rates rise, the interest expenses will become unsustainable. The government needs inflation to devalue, to erode away the value of old debts, because they can't afford to pay interest on new debts. I found that to be a very interesting statement. And if you believe the MMT side of the camp, which is that they can continuously print money without causing inflation, well, then that would make sense in terms of what they're doing now. They're really printing money, and the Jerome Powell, the Federal Reserve Chairman, has said that he does not see inflation to be a persistent long-term force. He sees it spiking up, but it's not going to be a persistent long-term force. And he said that there has been a decoupling between the money supply and inflation, which basically translates to, I don't think printing money is going to lead to inflation. It's basically what he's been saying.
It's interesting. And you made a comment to that as well when you talked about the $1.9 trillion stimulus package, which made it sound like MMT is just acceptable. Like it's Main Street now. It's like mainstream media. Like it doesn't make a big effect anymore. It's just part of it. As you said, well, it's just 1.9 trillion. We've done more last March, right? It's just like there's a bit of a nonchalantness maybe about it as well. Yeah. Like it doesn't have that effect anymore. Like you think it used to. And we as gold investors, we look at it as like, why doesn't have it that effect, right? It has been widely accepted, which is really interesting.
Yeah.
Right? All right. I got to pick your brain on some of your guests now. Right, you don't have to answer like with names or anything, but I really want to know some of the most controversial things you heard. And you always got to keep a straight face. You're at Kitco News. You're a news anchor, right? So you got to keep it straight. What were some of the most outrageous things you've heard? Is there give us some outtakes, and don't name names if you don't want to, and if the person is obviously not fine with it. I don't want to slander or butcher anybody here.
No, I understand.
But it's just interesting, right?
Well, I don't know about. I wouldn't use the word outlandish or, I would say bold calls. Some of the boldest calls I've heard is that we're going to get a 40% correction in equities by April, which is less than 30 days from now. I've had several guests comment on that call, whether or not that's going to happen. And the equities bulls obviously say no. The equities bears say could happen, but probably not by next March or next month. The lowest gold price prediction I've gotten was also from the same guest, and he called for gold to retrace to near $1,000 levels, $1,200 levels. By the way, that was one of the reasons I had. Remember that conversation I had with you last time? You said we need unicorns before we see $1,200 gold. That was kind of where that came from, and I wanted to pitch that to you to see how you would react. I more or less agree with you. I don't think we'll hit that level. Here's the thing: like the all-in sustaining cost of mining for most of the seniors is around $900 to $1,000. So that really should be your floor for gold. Any lower than that, then it becomes uneconomic to mine gold, and then gold will eventually rise back up to its equilibrium. So I don't think gold's going to go to $1,000, which is probably the lowest I've heard. On the high side, I've heard $15,000, $20,000 gold. The Dow gold ratio is one of the reasons for why gold will go to $20,000. If you look historically, how in the past the Dow gold ratio has been at certain times 1-to-1, and it's not 1-to-1 now. If you assume it's going to go to 1-to-1, then what's going to happen is, gold's going to rise to 20,000 points, $20,000 1-to-1 for the Dow. That's one assumption you can make. So those are some of the more extreme calls on either end, and of course everything in between. Most bank analysts I've spoken to have a range of around $1,900 to $2,000 by the end of the year as an average.
Like if you think about it, right? Like say $5,000 gold, like what kind of other environment would we be living in? If you zoom out a bit, like what does the world look like at $5,000 gold, right? Like
that's a good question, Kai, and that depends on the time frame. If you're saying $5,000 gold by next month, I would say the world needs to have like a nuclear apocalypse.
I was going to say like zombie apocalypse and unicorns in the street, like on the other end, right? Like,
but if it's $5,000 in 10 years, I would say no difference. I mean, think about how far gold has risen just over the last decade and a half. I'd say a 2x increase over the next 10 years, which is how long these bull cycles usually last, is not impossible, and in fact is quite normal. So it really depends on the time frame. If you're talking about 5,000 gold in 10, 15 years, sure, nothing's going to change. 5,000 gold in 2 years, we'll need an apocalypse.
That's aggressive, right? Who was your favorite guest on the program? Who's somebody you learned the most from? And
Look,
I actually do want to name because
guests.
It's positive, right?
Yeah.
Like who's somebody
sure.
like, oh, I actually learned something here. This was an outstanding interview. This was a great conversation. That guy has some very smart views. Or girl, sorry, not guys and girls. I was told the other day, guy is still a universal term. So,
look, I don't know if I can name a single person. Well, first of all, I enjoy speaking with you. I always learn something from you. So I'm not just saying that because you're there, but I always invite you back. I came from a macro background, so I think I personally relate most to people who have a similar research sort of thought process as me. I really enjoyed speaking to Lynn Alden. I've had her on the show a couple of times. She's a brilliant mind, and I think I've learned a lot of what I said I learned from her. And coming into the gold space, I really didn't know a lot about the drivers of gold. It took me a while to figure out the relationship between gold and inflation, gold and the dollar. And now I'm starting to question all these baseline assumptions that a lot of gold bugs are making on a regular basis. And so I think I've learned a lot about the macro variables around gold from Lynn Alden. From a philosophy standpoint of how to invest, Rick Rule is a good name. He's if you want to talk about how to invest in the gold sector, I think I've learned a lot just speaking with him. Jim Rogers has also very good investment philosophies that are applicable to any investor, not just in the gold space. I would say those names stick out to me the most.
Yeah. Who made you the most nervous?
I spoke to Ron Paul a couple of times, and he's a very, very nice man, but it's always nerve-wracking speaking to a famous politician. So I don't get nervous all that often, but I was tuned in, should I say. I was more tuned in, but it did well. I got over 1 million views last time I spoke to him.
Oh, phenomenal. No, that's great. And do you invest in the space as well? Like in the junior mining spaces, or do you own junior mining stocks? And like, are you using the knowledge you're gathering to your own advantage?
I get asked that all the time. I am not currently investing in the junior mining space. I would like to be. If I were to put money in the gold mining equity space, I would probably lean more on the senior side as a sort of a leverage play to gold. I think in the junior space, you really need to know the deposits, the management team to gain a competitive edge. And that's not my wheelhouse. I leave it to experts like yourself to generate alpha in that regard. Mining in the junior space to me is not the same thing as investing in the junior space to me is not the same thing as investing in gold. It's very much a bottom up process for me.
Okay, no, that makes a lot of sense, and really, really appreciate your insights. We're out of time. Like we've been chatting, and I could be chatting with you for a while.
That was fun. That didn't last very long.
No, it just flies by, right? And that's it. It's insane. David, thanks so much for making the time. I know it's been a busy PDAC week, or it is a busy PDAC week. Yeah. We purposely left it on the Wednesday, which is usually the slower day at PDAC. So I really appreciate you coming on. Thanks for sharing your insights. It was super insightful. Your Big Mac US dollar index. Let's hope I'm on the positive side. Let's hope it goes further up.
Yeah.
That the gold price increases and we get more purchasing power that way. Really appreciate it. Thanks for coming on. Thanks for sharing it with us.
Thank you, Kai. Thank you, Kai. And if you ever have any questions, please come on back on the show. And if you're watching now, reach out to me on Twitter, and we'll connect there. Thank you.
Awesome. Thanks so much, David. Everybody else, this was SF Online Session 7. I can't believe it's already over. Time flies. It's unbelievable. So I'm excited to be introducing the next session already. Session 8 is happening April 14th. So make sure to sign up for that as well. It's already available on our website, soarfinancial.com/events. Session 7, we will make the replays obviously available on our YouTube channel, youtube.com/soarfinancial. Make sure to subscribe to our channel, obviously. Turn on a little bell icon because we do pretty much daily interviews with companies as well. All of them are live. That way you do have an information advantage and a bit of an edge over other investors that might just be watching the replay the night following the upload, for example. So make sure to tune in, hit that subscribe button as well. Same on Twitter. We're quite active on Twitter at Soar Financial as well. We announce our events there, obviously companies that will be presenting, our keynote speakers. We're extremely excited to be hosting Deutsche Goldmesse at the end of May 24th and 25th. Go to deutschegoldmesse.online, and that's German gold show for you American and Canadian listeners. Really appreciate you tuning in. And that's it from our end. I don't think I have anything further to mention. Thanks again to my team that's crazy enough like me to get up at 4:45 and make this happen. This was a super smooth and well-run event, in my opinion. So thanks for that. Thanks for your questions. And if you have any questions for us, make sure to send us an email, reach out to us on Twitter or all the other social media platforms we're on. And thanks for watching. Thanks for tuning in. And we'll be back soon.